everyone, Chicago Realtor. Today I am with Mike, who is a mortgage lender who's going to be answering some questions for us. Thank you so much for joining.
Thank you for having me. I love talking to you.
Wonderful. Now, let's just get right into it.
Sure.
Someone realizes and knows, I want to cash out refinance. They understand the premise behind it, but what are the steps, 1, 2, 3, 4, 5, that someone can expect? Because you just don't say, I want to cash out refinance, give me my money.
Yeah.
There's a lot more that goes into it.
It'd be nice if it was that easy, right?
If only.
Yeah, so the difference between, the purchase process and a rate and term or even a cash out refi is that you already have the house, right? So for the most part, if nothing has changed in terms of your employment or how much money you make or the debt that you've taken on, you already pretty much qualify for the home. So that usually takes care of that part, right? So those are some of the first questions. So if I did the purchase and I know the client, my first questions are going to be, hey, has anything changed in terms of your employment or your debt load, right? Did you open up any new major debts that I didn't know about on the previous transaction? We'll properly add those to your liabilities to make sure that you still qualify. So let's assume that the client, nothing has changed. They're still with the same employer. They still make the same amount of money. They still qualify for the loan.
Great.
Then we're going to look at, okay, you want to access the equity in your home. Well, how much equity do we have, right? Okay, when did you purchase the home? We're going to run some comps. I'm going to take a look at some of the data in the area. Again, comparable sales that have gone on in the last 12 months to see, okay, square footage, bedrooms, bathrooms. Has it been renovated recently? Did you make any updates to the house since you bought it? Let's take that into consideration. And then there's a couple tools that we have at our disposal at the company where, I can get a good idea of the value with an automated value.
Who's in charge for paying for the appraisal and for all of the services?
Yeah, so during a refi, on a purchase, the borrower is typically going to pay for their appraisal up front. It's one of the only costs that you're going to pay before you close, aside from your inspection or anything that you do third party. But on a refi, something that we want to make it attractive to the client and say, hey, we're going to pay for the appraisal up front. That way, if it comes in short, and the deal no longer makes sense.
No harm, no foul.
No harm, no foul. You've come out of pocket for absolutely nothing. We'll eat the cost of the appraisal, and we'll go on our merry way, and we'll try it again down the road.
But if it goes well,
yep,
then you still pay for it.
Yes.
Okay.
But again, we're going to set that up to where you're bringing that money to the closing table, or with a cash out refi, you're never really bringing money. You're just going to get less than you would at the closing table. So it'll be your cash out proceeds less whatever the loan costs were, being your title fees, the lender fees, and any appraisal or third party costs.
Great. Is there a certain date when it goes into full effect once all the paperwork's been processed? Do you already have it set on there? So say they want March 20th for it to all go down. Do you have any say?
Yeah. So funding on a refi is typically 4 days because they have a 3-day right of rescission period.
Quick.
So after they've signed on the dotted line with the notary, once we close on the house, we get our CTC, we close. They actually don't. Where purchases, you typically fund the same exact day that you close. On a refi, you have what's called a 3-day right of rescission. And so that means that after the loan closes and the borrower signed on the dotted line, they still have 3 days to basically back out of the deal.
Should it not be the number they wanted? Should they decide it doesn't work for them?
Exactly.
Or they just get cold feet? And,
Yeah,
I'm
absolutely. There's a multitude of reasons why people have done it.
Yeah.
Again, maybe the husband didn't talk it over with the wife before she signed
Surprise!
up. Hey, by the way, I got us $100,000. It's going to cost us a little bit. Yeah. Maybe something was screwed up on the paperwork. They got cold feet. They just don't need the money for the investment anymore. Whatever it is, they have 3 days to basically make that decision. And on the 4th day, we fund that money. And they can get it, one of two ways. We can either wire it directly from the title company to their bank account, or we can have the title company cut them a check.
Say with your experience that when you do a cash out, you can also refinance into a different type of loan.
Definitely.
It doesn't have to be the exact same one. So if
No.
you go the FHA route, you occupy it for a year, you can then refinance it while you're already doing your cash out.
Yeah, absolutely. So going from loan program or loan product to loan product is absolutely possible. Again, people going from an FHA loan to a conventional loan, more often than not, it's to drop off what is called mortgage insurance premium. That's MIP or UFMIP, which is upfront mortgage insurance premium. That's on FHA loans. The only difference between those two types of loan products is that, and there's a few, I shouldn't say the only one, but the main one is that mortgage insurance on an FHA loan is on there for the life of the loan, whereas on a conventional loan, mortgage insurance will fall off once you reach a certain loan to value, which is 78%.
This is important for everyone watching, that the loan that you go under contract with and have the house does not have to be your forever loan, should another service better suit your needs along the years.
Yeah, I mean, we always tell people, like I do at least, is that there's ways for us to get you into the house. Like if this is the house that you want to get into, you might not qualify for a conventional loan today, but hey, like let's get you into the house first and worry about restructuring it down the line, because that's always possible. Whether it's getting your credit score up because you'll be making on-time payments with a mortgage, that's going to absolutely increase your credit score as long as you're making them on time, right? So make your payments on time.
Make your payments.
That, and then the pay down of the mortgage. So like as you pay that thing down and you owe less, your payment drops, or you're able to refi and capture a lower rate of interest, that's going to affect what your debt to income ratio is. So you might have only qualified for an FHA loan at that time, but maybe in the next couple of years, you're either making more money, you were able to reduce the monthly payment. So now that conventional loan makes sense, and we're able to drop off that mortgage insurance or give you cheaper mortgage insurance with a conventional loan.
My last question would be, when you are going through the process, I know that a lot of investors like to go this route in terms of making the cosmetic upgrades. Are there any other times when it would be beneficial for someone to do a cash out refinance if, you know, say it's just been 5 years and their home appreciated value maybe 50, 80K, or is it more so for the people that make those cosmetic upgrades to now justify the price?
Yeah, so again, I think being able to leverage and utilize your home as essentially a bank is an awesome tool that we have here.
It's huge.
You know, because a lot of people, their home, for most people, this is their biggest asset. You know, unless you have some type of crazy investment portfolio, but for the most part, real estate is going to be your biggest asset. So being able to leverage that and get into, you know, being able to purchase more cash flowing assets. So cash out refi to basically pull out money to then invest in another property like that is an unbelievable way to
keep it going.
Yes,
keep it going.
So we call that the velocity of money. How many times can I use the same dollar over and over again to fund my investments? So, you know, and there's other creative ways of financing through, you know, things like the Burr method, where you're buying, rehabbing, renting, refinancing, and renting. So you're essentially wholesaling a property, buying it in cash, funding the renovations, and this can all be done with hard or private money, where you're basically coming to closing with none of your own funds, and you're purchasing these properties, you're rehabbing them, and then you're cash out refining them to pull out the money that you put into it to then invest in another one, and you keep that cycle going. And that's how people grow these massive real estate portfolios off of, you know, none of their own funds.
Right.
Yeah.